Greece's finance minister called today's meeting with the country's private creditors its moment of truth. And there are signs that both sides may finally be coming to that realization. Hopes for an agreement sent shares higher across Europe, including Greek banking stocks, which rose 5% on the day. Bill Gross is the founder and co-chief investment officer for Pimco, the world's largest bond fund manager. He joins us with his insight. Thank you very much for coming on the program today.
You're welcome. Thank you, Danielle.
So signs of optimism, we've heard about this, of course, many times, but I guess depending on the new coupon that's negotiated, we're talking about a haircut that could be much more than 50%. So I want to start by asking you how far you think the government is going to be able to push private sector investors on this.
Well, it appears, Danielle, that 32 cents, 30 cents is probably the effective haircut. You know, the advertised number is 50%, but as you correctly say, you know, the coupon, whether it's 3, 4, or 5, is significant as well in terms of that longer-term debt that replaces the voluntarily exchanged debt. So 32 cents, that's a pretty significant haircut. Will Greece be able to recover from that level? You know, we think there are other problems, other structural problems that will inhibit their growth going forward, but this is a start.
Mr. Gross, as the Greeks have been trying to renegotiate the debt, we've seen massive swings in sovereign debt across the Eurozone, seemingly from day to day. Does the world really change that much every day?
I don't think so, David. And we are increasingly suspicious as to who is buying their auctions. You know, Spain has had an auction. Italy has had a number of them. You know, it's fair to look at the glass as half full, but it's also fair to suggest that the purchases have taken place at the expense of local banks and at the expense basically of the ECB itself, which is providing the credit. So, you know, the only real solution to Euroland's problem is to encourage outside investment, and that could come from China, that could come from the United States, that could come from the Pimcos of the world. But to the extent that it's all financed internally, it becomes a Ponzi scheme with a small p.
You know, you said a second ago that with a 30% haircut, maybe Greece could recover from those levels. Are you still betting on a default? And if so, what would it look like?
Yeah, we are, Danielle. You know, hopefully it's orderly as opposed to disorderly. You know, it could come with this particular agreement in terms of an exchange, but that to us is a default in everything but name only. Perhaps not with CDS contracts, but a default in anything but name only. What Greece really needs to do is get out from under the burden of high real wages. I mean, they've slipped over the past 5 to 10 years by increasing their wages relative to Germany, relative to China, relative to the rest of the world. And so their inability to escape from the euro currency, I think, is critical going forward. And can they do that within the structure of the current Eurozone? No, they cannot. Nor can Italy, nor can Spain, nor can Portugal. And so that presents problems in terms of the ultimate growth of these particular regions.
And whether the default is orderly or not, of course, we're seeing the rating agencies having downgrades across the Eurozone on a regular basis, and Canada remains one of the few AAA nations. As Canadians, can we take any excitement out of that? Are we going to see more foreign investment into Canada as a safe haven?
Well, I think Canadians should. I mean, you know, my parents were Canadian. I've got a little Canadian blood myself, so I take some pride in the Canadian way in terms of their balance sheet and their fiscal conservatism over the past 5 to 10 to 15 years. So sure, take some comfort in that. We call Canada one of the clean, dirty shirt countries. That means, yeah, Canada has some debt. Yes, there's some problems going forward in terms of its structural orientation, in terms of its commodity-related growth going forward. But, you know, it's a pretty clean, dirty shirt. It stands up there with the United States, with Germany, with the UK, and certainly they have the ability to print their way out with independence from the standpoint of their own central bank. So Canada's got a lot of things going for them.
It's still a pretty small market, though, for international investors. And just sort of judging the size of the potential foreign demand out there, I'm wondering if you see that creating any problems for us. Because it's interesting, just this week, you know, Mark Carney was saying that because of all the flows into Canadian paper, this is one of the reasons that we're seeing the banks lower mortgage rates. There's a whole spill-on effect. There's a currency effect as well.
Well, I think so. I mean, that to a certain extent is a reflection of the size of Canada's economy. You build the economy, and I suppose you become bigger in terms of the global marketplace. But, you know, Canada is still a viable liquid market for companies such as Pimco. We've bought Canadian housing bonds, we've bought Canadian government bonds, and now we're looking at, obviously, at provincial debt, which trades at 70 to 80 basis points higher than the Canadian government, and which we consider to be, you know, close to agency status, much like in the United States. So there are alternatives there. We can't obviously invest $1 trillion worth of our clients' money in Canada, but it's relatively liquid, and we're moving forward in that regard.
Now, you've gone on record to say that in the new normal, or the paranormal as you call it, that investors could only really expect 2 to 5% returns in the coming years. Obviously, that's not enough for the hedge fund managers to make the kind of fees they need to go buy the big houses in Greenwich. So for those managers that are going to seek outsized returns, where do you think they're going to get burned?
Well, they're going to get burned by using excessive leverage. I mean, that's been the problem over the past 5 to 10 years, David. And to the extent that you use or combine leverage with excessive risk, then you have a subprime type of potential. You know, can you lever up, so to speak, with relatively riskless types of assets? Yeah, that's possible, but hedge funds aren't really content with that 4 to 5% type of return. They're expected to produce double-digit types of returns. And in this world, really, with interest rates, for instance, in the United States, on a real basis in negative territory, and in Canada, you know, close to that as well, then it's very difficult to produce, you know, double-digit types of returns without taking excessive risk and without combining it with excessive leverage. So, you know, be careful if you're running an old hedge fund model relative to what is required in this new age paranormal type of economy.
Bill, just to end, if we can bring it back to Europe for just a second, because you've talked about, I guess, the hope for an orderly default out of Greece and maybe some contagion with some of the other countries. Can you just tell us how you see it, sort of what the markers are going forward, what you think will actually happen, and maybe what the warning signals would be if things start to become not orderly?
Well, I think, Danielle, that, I mean, the true signal is, can Euroland countries and can the peripherals grow under the blanket of fiscal conservatism and a straitjacket in terms of high interest rates? Yes, it will help to lower Portuguese interest rates from 16% to 10%, and from Italian interest rates from 7 to 5. But ultimately, the ability to grow will be dependent not only on lower interest rates, but on their ability to grow within the restrictiveness of fiscal budgets that move closer and closer to the balanced budget line. You know, typically a balanced budget over a long period of time is a good thing, but over a short period of time can hamper growth. So we'll be looking for growth rates, we'll be looking for interest rates, and the combination of both to see whether or not any of these countries can get out from under.
All right, Bill Gross, thank you very much for your time.
Thank you, Danielle.